Welcome investors to the 40 Finance channel. My name's Jeff Beers. Today I've got 3 stocks for you that I've come through last few weeks that I think have 25% upside through the end of the year, maybe into Q4 earnings report season, which would land kind of January, February. But for as high as the market is right now, and the same names being talked about over and over again, I thought it might be fun to come in here with 3 sort of fresh picks that I haven't talked about and share them with you guys. As always, my stock picks and projections, though, they're just my opinion for your entertainment. Please make sure you do your own research and due diligence before investing in any stock. And if you like stock analysis like this, then be sure to subscribe to the 40 Finance channel. Thank you to everyone who has supported the channel so far. And finally, if you're interested in joining my email list, I have my free 15-minute stock analysis guide for you when you sign up. You can find the link to sign up and get your free guide right here in the video description. All right, just a recap of what we're talking about here. These are 3 stocks that, in my personal opinion, have the opportunity to jump 25% or more by February 1st, 2021. Honestly, I think that they could all pop even well before that. However, I just wanted to call out because Q4 earnings come in, all the way through December 31st, but then it takes companies like another 30 some odd days to come out and report those earnings. So that's why I'm leaving a little bit of a buffer zone into February 1st. And if you're familiar with the channel, I don't get into pump and dump and mining stocks and penny stocks and things like that. Looking for solid companies, like real companies that have real products and services. So there's no trash here, I guess you would say. I do want to be clear, though, that I do not own any of these companies, so I'm not really putting my money where my mouth is, whatever the saying is there. However, I could jump into them at any point. And lastly, one of the keys to a list like this with a plus 25% list is just know you might have to preserve your gains along the way. While I think these stocks generally qualify for long-term holds, just know that if you're banking on the 25%, that you may have to jump out when it hits there, particularly if the economy or the election or China or whatever happens in the world looks kind of ominous in the future. You could hit that 25%, and if that's really important to you, you might also have to sell. All right, first on the board is BJ's Wholesale Club. And shout out to one of the commenters. I wish I would have wrote your name down before I started this, but he or she has been asking me about BJ's Wholesale Club for about a month now, and I did take a look at it, and it looks pretty good. So let's go over what we've got here. BJ's Wholesale Club, very similar to like a Costco type setup, just not quite as big or not as nationwide. You look in the yellow boxes there, you got a P today of $18.96. EPS of $2.16. I circled the earnings date there because that could be a big play if you're going for short-term gains. Will BJ's come out with a big quarter and perhaps upgraded guidance for the holiday season? So make sure you recognize that date and proceed as it matters to you. 52-week range on this one all the way down to $18.84 and has reached a high of $47.46. So almost $48. You're down to about $41 today. The metrics at the top there, the average PE of 20 with the little asterisk, that's only because that's me eyeballing it, okay? So that's not any sort of official statistic, but I went back on recent quarters and they're falling about in the 20 range. The forward PE is going in the right direction, which is down, dropping to 15.5. This is not a small company, okay? So trailing 12 months revenue, $14.4 billion, fairly solid. A little light on cash on hand of $168 billion, certainly compared to the debt load of $3.3 billion. So that's not the best ratio in the world. However, I will say if you look again at TTM revenue, this is a company that's bringing in $14 billion over 12 months. So their cash flow is strong, so I'm not super worried about that. All right, looking at the tip ranks dashboard to just get a feel for what other experts think. think about BJ's. Reminder with tip ranks, I sort only by the 4 and 5 star analysts, try to get some quality picks out of it. And you can see that you've got a lot of 50s in there, which is exactly what we're hoping for, at least in terms of this particular video. And the most recent ones are the top two at the board. So a buy at 50 and a buy at 54. That's going to be super close to the 25% threshold. But I really like what I see out of BJ's, and they are still growing and opening new stores. So this one I'm going to give the benefit of the doubt on the 25%. All right, I grabbed one news clip here from September 21st. This one was on Seeking Alpha. This is not an opinion piece. This is just, the news reporting. So Goldman Sachs reiterates a buy on BJ's Wholesale Club. Kate McShane says the firm's positive thesis on BJ's is based on new member acquisition, strong unit growth story with significant runway for long-term growth, a balance sheet bolstered by record free cash flow, as well as progress on general merchandise expansion, cost initiatives, and higher membership income. And bullet point 3 there is the quote, while shares are up significantly over the past year, the recent pullback has created a compelling entry point in our view for potential earnings upside and multiple expansion. All right, so BJ's Wholesale Club, I think it looks pretty strong, similar to like a Target and a Walmart, just at a smaller, higher growth level. Just know when you're in retail, it's very unlikely that you're going to see 100% gains or 50% gains or things like that. So when you hear something like BJ's and you think about a 25% gain in the short term, that is a really strong retail stock. So do some more research on that one if you're interested. Next up on the board, we're going to go to eHealth Incorporated. All right, eHealth, ticker symbol EHTH. Stock price today of $82.55. Scrolling down to the yellow boxes, you got a PE ratio today of 28.27. EPS of almost $3 at $2.92. This one has an earnings date right around the corner, okay? So next week on October 22nd. So I'm either going to be super right or super wrong, probably on the 25% prediction. We will find out a lot about that on October 22nd, so we'll see how it goes. Just know that if you're interested in this one and you're bullish on it, I would recommend that you buy before the earnings date if you're going to try to capture all 25% of the potential gains. But just know there's risk there too, and we'll talk about it in a little bit. 52-week range of $53 to $152. And you look off to the chart here and you see that we are right in the middle of all that. eHealth Incorporated, I probably should have kicked off with this. This is an online medical insurance provider where you put in applications for traditional health insurance. They've also found this niche of Medicare insurance that has proven to be profitable. And I've read in the insurance company that this is a big thing in general. And eHealth has found some recent benefits to it. When you look at the chart though, they did have some cancellations, I think it was, in their last earnings report. Their last earnings report was good. They had some cancellations. Analysts got down on the stock. So here was something that was riding, 120 or so even after the pandemic was announced. But the analysts got spooked. Now you got another earnings call coming up on October 22nd. So we'll see how things shake out. Looking at the top of the board, you got an average PE of at least 50, if not more. This one only recently turned profitable, maybe 4 or 5 quarters ago. This company is starting to mature from a profitability standpoint. You got a forward PE of 1736. Relatively small company, trailing 12 months revenue of $500 million. They've got $200 million in cash and a debt load of $50 million. All right, taking a look at the tip ranks dashboard. You see it's sort of a mixed bag. The first person who just initiated coverage at the top, they did not include a price target. So we have to go to the next line, which was 19 days ago at 101. That's only a 22% upside. But then you see down below, some of the other analysts are coming in with higher numbers. So obviously this is one that I have bigger thoughts for, I guess you would say. And a lot of that reason that I'm coming in stronger on this one, at least from a pick scenario, is just that I think with the presidential election and heading into next year, there's a lot of changes in the marketplace with health insurance. I think there's a lot of new ways people are working on a contract basis, etc. And you never know what will happen with health insurance after the presidential election. So I could see a scenario where it possibly could spike applications, and that's why I like this one right now. All right, little news clipping about eHealth here. And this is one of the warning signs, so I wanted to make sure it included here. eHealth growth unlikely impacted by Walmart entrance. Deutsche Bank analyst George Hill says the market clearly sees increased risk for eHealth after Walmart provided details on its insurance services unit to assist people with enrolling in Medicare Advantage. The analyst, however, views Walmart's entry as validation of the attractiveness of the end market and feels the company is unlikely to inhibit eHealth's growth. He keeps a buy rating on eHealth. So you get the picture there. Walmart is providing some sort of service in the space. I tend to agree with this George Hill in the sense that, I don't go to Walmart for health insurance. And while Walmart has, the reach that they do, it just doesn't match for me. And I would feel a lot better with an online application process from a company that specializes in health insurance. That's my take anyway. All right, last stock on the board today is Rackspace Technology, and this is an IPO, so I had to generate some of the metrics for you. You can see that there's no PE or EPS in the yellow boxes. 52-week range is $15 to $22. It looks like the IPO came in right at the beginning of August there. And Rackspace is on my list because it falls right in to that cloud service provider with different applications to help you tie all of your cloud processing together. Obviously, this space is getting a lot of attention here lately and could be arguably a little crowded. However, I'm familiar with Rackspace because they've been in business for a long time and they've been doing this type of thing for a while. They're just now coming to light with this IPO. But the bright side of all this, guys, in my opinion, is that this was one of those IPOs that, since the name wasn't new and it was essentially an established business, nobody was super interested in it. And you can see it's just sort of a flatline IPO right now. So that could be an opportunity. If you look up at the EPS estimates for this year, by the end of it, they're supposed to come in at 80 cents and next year to $1.13. So the PE on this one, if they do land at 80 cents, you got a PE of 22 for, a cloud service provider. So that's pretty big. And then next year, if you were going to base it off of that, you got a PE of 16, so you're headed in the right direction. You take a look at 12 months revenue of $2.5 billion, so this is not a tiny company by any stretch of the imagination. A little light with the cash on hand at $160 million, and certainly compared to that debt load of $4.6 billion. I don't know if this is true, but sometimes when you go into these IPOs, it gets really expensive because you have to prepare your company from an accounting standpoint, etc. But either way, maybe the debt load running a little hot could be the reason that it hasn't taken off. But I feel really good that the sales are going to matriculate with this company. It may not be 100% growth story, but plus 25, I think, is pretty reasonable to say the least. All right, looking at the Tip Ranks dashboard, you can see, I think all of these came out right when the IPO hit. Well, they're all showing 1 month ago anyway. And just doing an eyeball assessment, you got basically, mid to high 20s in there. A lot of room to run here yet. And again, on this, you're getting in at basically the IPO price. So that's a pretty attractive entry price if you think about where the projected PE sits and where this company's going. Again, slow and steady gains here, but I think they're pretty rock solid. I could not find an earnings report date for this one, and I don't know if that is because the IPO was so recent. So you may have to wait a little bit longer for an earnings report. Do your research on that, but at some point they're going to report their 2020 earnings, and that's your next catalyst. All right, quick news clip here. Barclays analyst Raimo Lenschow initiates coverage on Rackspace with an overweight rating and a price target of 24. Comments are, why we like Rackspace. Number one, it's well aligned to a large multi-cloud TAM market with attractive industry tailwinds. 2, valuation discount to peers. 3, recent biz transformation has turned hyperscalers from competitors into partners. 4, high degree of recurring revenue. 5, lessening capital intensity. 6, mission critical nature of cloud services makes Rackspace somewhat COVID resilient. And 7, impressive bookings improvement from new management. All right, so there you go, guys. 3 stocks that I think have 25% plus to run, certainly by the time Q4 earnings are reported in the beginning of February, but very well could happen before that. So hope you like this look at some fresh names. I tried to stay away from the stuff that's kind of trampled down that you hear about all the time on CNBC. So let me know what you think of these companies in the comments. And of course, give me a like and subscribe if you enjoyed this video.